Hello, I'm Brett Walker, an agribusiness specialist with the Accel Group. The Accel Group is a multifaceted risk and wealth management organization located in Cedar Rapids, Cedar Falls, Waverly, Coralville, and Des Moines. Today's presentation is going to be based on margin protection crop insurance. Margin protection crop insurance is what we would consider to be a third generation crop insurance policy. First generation being yield only, second generation would be yield and price or revenue, and this third generation protects us from decreasing yield, decreasing price, and the volatile side of the inputs. I'm going to go through a few of the features of margin protection crop insurance, and then we'll get into the nuts and bolts. First of all, margin protection crop insurance has a sales closing date of September 30th. So that is approaching fairly quickly. The risk discovery or price discovery periods are August 15th through September 15th. This would be for the commodity that you are insuring and also for the input prices that are part of the formulation. So the product is designed to not only protect you against lower yields and prices, but also to ensure a margin on, not necessarily on your farm, but for your operation and account for the possibility of input prices going higher. At the Accel Group, we like margin protection insurance because we can buy it at a 95% level. This is the highest coverage level that you can buy in the industry. We think the climate is favorable this year due to the political situation and the cycle in commodity prices that add some inherent risk to the operation for 2020. When we look at margin protection insurance, not only do we include the commodity price, it's based on county yields, but we're also including the input that you use to grow your crop. For example, we're going to consider diesel fuel, phosphorus, potash, interest rates, and nitrogen to help figure your margin. I've included the commodity charts on the corresponding input items for a margin policy: diesel fuel, interest rates, phosphorus, potassium, and nitrogen. As you can see, most of these charts have been trending downward. Therefore, we think it's a good time to capture that input price. Each of these components is used to help calculate the margin for your policy. The formulation is all based on your expected county yield. For example, in Bramer County, the expected county yield for 2020 is 198.8 bushel. Therefore, that's the number we're going to use in each equation. You take, for example, diesel fuel, you take 198.8 times 0.04 and add 2.5 gallons to that. That will be the amount of fuel that you will need to produce an acre of corn in 2020. You can see there is also $1.80 in parentheses. That is the input value that as of August 25th that we will use for the diesel fuel price. You can also see that we have similar formulas for nitrogen, phosphorus, potassium, and then there's an interest calculation, and you can walk through that formulation also. There's also what we call fixed cost in this production number. Each county is assigned a fixed cost number. This is to represent your seed and machinery costs. These may vary slightly from county to county, but each county has one. We add in the variable cost that we just went through to the fixed cost to determine our total cost to calculate our margin. So in this example, we're going to focus on corn. We're going to use Bramer County's yield at 198.8, and we're going to use the inputs that we just walked through. So to figure our expected margin, we take our county expected yield times, I'm assuming, a $4.05 price. That too is determined between August 15th and September 15th. Multiply those together to get our revenue. From that, we will subtract our fixed and variable cost to get our target revenue. Now, we have a deductible in our policy. In our example, I'm using a 95% policy. So, therefore, we have a 5% deductible. So take your $484.27 times 5%, and that is your deductible. Subtract your deductible from your expected margin, and that is your trigger margin. Now that we've established our trigger margin, let's take a look at our harvest margin. We take the actual county yield determined by RMA times the fall price, which is determined in the month of October, and in this example we use 200 bushels times $3.62. You then subtract your input costs of $320.87, and in this example we held that constant. We end up with a harvest margin of $403.13. Compare that to your trigger margin of $444.01, gives you a net margin loss of $40.88. At application time, you would have chosen a payment factor. The payment factor would range from 0.8 to 1.2%. In this example, we used 1.2%. So we took our margin loss times 1.2% to determine our indemnity of $49.06 per acre. I have another example of an indemnity. In this example, we used a higher harvest price and a lower yield. The calculations basically remain the same, and you can walk through them on your own. Now that we've walked through the calculations on a margin protection policy, there are a few other things that you need to know. Margin protection has no allowance for replant or prevented planting. However, if you purchase a margin protection policy, you will also have the opportunity to purchase a revenue policy in the spring once those prices are determined. And if you purchase a revenue protection policy, you will be credited premium on your margin protection policy. So you can basically have the best of both worlds. You will have county-based coverage with your margin plan, and you will have individual-based coverage through your revenue plan. If you purchase a revenue protection plan and receive an indemnity, this indemnity will be subtracted from your margin protection indemnity. The two work hand in hand. You will not collect indemnity under both scenarios. One other thing to be aware of is indemnities under the margin protection plan will not be paid until the late spring following the crop year. If you purchase a margin protection policy and a revenue protection policy in the same year, you will not collect indemnities under both policies. The revenue policy indemnity will be subtracted from the margin protection indemnity. If you receive an indemnity under a margin protection policy, it will not come until late spring after the crop is harvested. I've given you a brief introduction to margin protection insurance. If you have interest in this product, please contact Mark Lenius or myself at the Accel Group. Thank you for your time, and I hope you found this video of interest.